Hi, I wanted to show you a couple things that sometimes confuse students just a little bit when we're constructing pro forma financial statements. I want to talk about how we compute interest expense. And the reason I want to do this is because as debt levels change, interest expense changes, and that can be confusing. The other issue that I wanted to talk about is what happens if we end up with a negative loan amount as our plug figure. And I'll show you how to deal with that. So, computing interest expense. We know that as we compute these pro formas that debt levels are going to change because balance sheets have to balance and they're the plug figure, so they're going to vary. But in Excel or any other spreadsheet, we can't simultaneously solve for the interest expense, which is required to get the net income to compute the retained earnings to build the balance sheet, and the debt levels. What you're going to do if you try to do that is you're going to get the evil error reference for a circular reference in Excel. This is not a good thing. So what's the solution? It's really pretty straightforward. What we do is we compute interest expense outside of the pro forma, and then we type it in to the interest expense cell until the loan amount no longer changes. And what I call this is iterations to convergence. We're going to do enough iterations, enough repetitions until we converge on a loan amount that doesn't change. Here's an example. So 2013 is actual, 2014 will be our pro forma. And I've started this by inserting last year's interest, the $760 as interest expense. That gives us a starting point. But as you see, as we go down to the debt number, the plug figure, we get $8,422, which is less interest than we had before, or less debt than we had before. So there's going to be less interest. And in fact, the interest, 8% of 8,422 is $674. So what we'll do now is put $674 in for interest expense. We recompute and we get now a debt level of $8,342, a little less than the number we had last time. So interest goes down again. Now it's $669. So let's put that number in. And interest now is $8,358. And the interest has changed a teeny bit. But watch, we're going to put in 668 because we know interest is between 668 and 669. And there's no change in the loan. So we've converged on a solution. We know the loan amount and the interest is either 668 or rounded up, it's 669. So this would be the answer that we'd plug in there. And because these pro formas are just getting close kind of exercise, not an exact thing, either of those answers would be fine, 668 or 669. It looks to me like this thing really rounds up to 669, so that's probably what we should put in. Okay, so pretty straightforward. Now, one thing that we did here, and it's important to remember, is we assumed that the annual interest is based on the year-end amount. In this case, $8,358. That assumes that the reduction occurs on January 1st of the calendar year, and so we're always computing interest on this new lower amount. But suppose that we paid the debt off slowly over the year and assume that was evenly over the year. Then we could change the interest a little bit by using the starting loan amount plus the ending amount divided by 2 to get, and then multiply by the interest rate to get interest, and that would probably be a little more realistic. Anyway, be aware that the way we've done it assumes that the reduction occurs right at the start of the year and the new balance is in place for the entire 12 months, where in fact that may not be the case. Okay, next issue, negative loan amounts. This is really pretty straightforward. So we can't have negative loan amounts. And so what do? We make the loan amount 0, and then we just adjust all of the items until the amount of the negative loan becomes a positive amount added to cash. So Here we have a negative bank loan. I've just made up a little teeny balance sheet here. Well, we don't like that negative 200. That's kind of silly. So what do? We turn it to 0. We adjust current liabilities. We adjust total liabilities. We adjust total assets, total current assets, and finally cash. And now that minus 200 became a positive 200 added to the initial balance of cash. So that's how we take care of negative loan balances. These are two little things you'll occasionally see in pro formas, and they'll just make you a little bit better financial forecaster. Thanks. Bye-bye.